Canadian home prices are absolutely collapsing. In this video, I'm going to take you through all the evidence of and show you why this could in fact be just the beginning of a massive collapse that eclipses the financial crisis in 2008. In the United States, some markets went down 60%. We're already starting to see the cracks. That could indeed happen. First of all, I just want to walk you through what is happening with the mortgage renewals over the next 1 to 2 years. There are a lot of mortgages that are going to be renewing. This is a problem. A lot of the people who took out these mortgages couldn't afford them back then. They were overstretching themselves when they took out the mortgage. They could barely afford it, and now they're completely unaffordable. There's absolutely no chance. So, a lot of those people are beginning to list their houses and try to sell them, anticipating the renewal, knowing that they are not going to be able to afford it. Some are downsizing, others are just trying to get into the rental market and sell out completely. Cashing in if they're in one of the markets still at the peak, like Calgary, Edmonton, Halifax, Nova Scotia. Those places that still have remnants of the hysteria in the market. It's very interesting when you look at these stats. For example, 19.3% of mortgages at TD are renewing over the next 1 to 2 years, 24.6 at the Scotiabank, 22.2 at CIBC, 29.4% at BMO, 21.5% at the National Bank, 21.6% at RBC, and finally, but even if you look at all the next 6 months, it's still a substantial amount. Between May 1st and October 31st, 2024, you've got 6.7% renewing at the TD, 8.1% at Scotiabank, 8.2% at CIBC, 5.2% at BMO, 8.1% at National Bank, and 12.8% at RBC. Obviously, this is going to have a massive impact on the real estate prices because a lot of people are going to be unloading properties. And since they simply cannot afford the increased payments, they cannot qualify to renew. Those lenders that aren't going to cut a check, people aren't going to bother with appraisals and everything like that, are going to pay the price for it in the end. If you don't credit check people when they're renewing their mortgage, you're the fool. You might think, oh, that's great because the person who took out the mortgage is going to be fine. But if they don't qualify for the mortgage, it creates a huge problem, exactly like we saw during the global financial crisis in 2008. You just have more and more subprime building in your supposedly prime mortgage portfolio. Anyway, lower mainland home sales have dropped despite the Bank of Canada interest rate cut. We saw this narrative from real estate industries that when interest rate cuts start, the prices and the market will explode. But we're actually seeing the opposite. Sales are down. For example, Vancouver, despite the Bank of Canada cutting its prime interest rates last month, the Fraser Valley Real Estate Board, as well as the Greater Vancouver Realtors, say it has done little to kickstart the home sales in the region. They recorded a 1,317 sales in June, down by 13% over the previous month, and down by another more 30% over 2023. This is really interesting because you've still got markets that might be topping, possibly still a lot of hysteria around the markets like Calgary, and the fundamentals are closing in on Calgary as well. The unemployment rate is now at 8.5%. Just imagine in Calgary, if the real estate market flips, the unemployment rate could go north of 10% very quickly. If you've got places like Vancouver slowing down, saying the narrative is true, and people are from other provinces but those markets are slowing down drastically. That's eventually going to feed into your market. Once the self reinforcing cycle of a bubble is interrupted, the whole market just rolls over because it can't sustain itself and the economy tanks. You haven't got people buying cars, furniture, and hiring people for the house they just bought. In a market like Edmonton, where there's a lot of hysteria, it impacts the economy until it's interrupted, and then you have a major problem. It's very interesting what's happening there. When you look at prices right now, they're coming down. It'll be very interesting to see what it looks like over the next couple of quarters when this chart is updated. This is a real residential property prices adjusted for inflation. As we're discussing many times, that's all that matters. When you look at where this bubble started, around 2003 and 2004, mortgage debt started to leave the historic trend. Income wasn't growing at the pace of mortgage debt, so you knew there was a bubble. Finally, in 2020, it went parabolic. This line practically went vertical. Mortgage debt was not any fundamentals. It hasn't been corrected to fundamentals since 2004. People incomes haven't been growing. When you look at the GDP capital per capita, we've just erased a decade's worth of growth. Let's get into what's happening with some of the staggering losses. For example, if you look at what people can buy with their money in the real world, not using the CIP, it's gonna down by 20 to 30% at least, plus the reduction of 33% in capital from investing in real estate bubble. It's very interesting that you've got B lenders blowout. And we really have to talk about these B lenders because they are massive risks to financial system. After buying the house for 2.35 million at the end of 2020, the investor almost immediately tried to rent it out for 7,000. Of course, nobody took it at that price because nobody could afford that price. The market for someone who can afford a $7,000 amount is slim and none. They didn't do any research on the average or medium incomes in that area. Then they tried to flip the house for 2.4. No takers. After several price reductions, the loss people are taking is huge on these houses, condos and townhouses. They bought at the height of the market in 2022. The buyers took a whopping $1.4 million loan and $10,000 a month payments. In April of this year, the B lender, River Rock, stepped in, served them with notice after they defaulted on their March payment. The home finally sold for $800,000, what they paid for it. Some B lenders have very little patience with delinquency borrowers. No wonder, since people who provided the capital for these mortgages are asking for their money back to invest in Federal Reserve bond at over 5%. The risk reward for this higher interest, higher risk loan isn't there, especially since the market's deterioration puts the capital at risk. The losses being taken here aren't small amounts, they're in the millions. Risky mortgages boomed during 2021, leading it to massive melt. Fixed payments, variable rate loans were extremely risky, and there was a boom in the mortgage corporations. Remember, default rates quoted by mainstream media are based on the big five banks and don't include mortgage insurances. With higher default rates, so the amount of the defaults could be way higher than people think, lending to massive listings and huge price cuts. In North York, freehold townhome prices are imploding after the developer slashed $500,000 of the list price. Immigration does impact speculation in housing market, but it's not a direct impact for new construction townhouses. They are massive discounts posted on the segment Facebook group. A townhome initially listed at 1.6 million is now selling for 1.1 million. Who can afford that medium household income in that area? It's a limited pool of people. The people who couldn't afford to operate in the market in the past 2 to 3 years were mostly speculating. When you're in this hyper bubble, some people mistake hysteria for strength in the market. For an example, a $2.3 million lawsuit for failure to close what can happen when buyers try to walk away from contract. Many buyers are doing this because they realize the market has flipped. Prices are coming down and they regret paying so much over the asking price. Buyers go after them for breach of contract. They likely won't recoup the amount they're seeking, and the buyers may declare bankruptcy. Most of the money homes like this was provided by the banks. Don't have the 843.3 million for those houses. This home eventually sold for 1.45 million after initially 2.3 million. They leased it out for 5,000 a month, resulting in an $825,000 loss in 2022. In Cambria, people are looking for bigger houses during the pandemic, outstretching themselves and not wanting to sell the condos in Toronto. They took riskier loans thinking interest rates were lower. Brokers wrote variable mortgages with massive fees. Now they're in a predicament. When rates go up and the lenders might not renew them, they're looking at an $825,000 loss. This scenario will happen all over the country, even in the hot markets like Calgary and Edmonton and Halifax. These markets depend on places like Vancouver and Toronto. The hysteria and the euphoria in those markets come with people moving from other markets thinking prices are lower, but not understanding why. Rental inventory is skyrocketing in Calgary and Edmonton, with rents declining, especially single family homes. Property value calculated based on rent. So if normal prices go up while rents go down, you're in a bubble territory. If the person can't sell the house, they can't rent it out to cover the costs. As markets slow down, Vancouver affects Calgary and Edmonton as well as Ontario, affects Halifax and New Brunswick. Speculation on the narrative people moving in is driving the market, not actually the narrative itself. If you enjoyed the video, please comment and share your thoughts below. Don't forget to like and subscribe and hit the notification bell so you never miss an update.